I met Christopher Tsai in June. We spoke about his investing strategy. He's a value investor, a growth investor. He managed roughly $100 million for his clients, and one of his favorites is Tesla, Alphabet, Apple, and all these technology stocks. He's a long-term investor and also the largest art collector of Ai Weiwei art, the Chinese dissident. They became friends, and Ai Weiwei even designed his vacation house upstate New York in the Hudson Valley. So we spoke about those interesting things, and we spoke roughly an hour. Take a look at it. Hi, Christopher. We have a very volatile year. It's very difficult. We have the war in the Ukraine. We have a problem with inflation. We have rising interest rates, which hurts the stock market because bonds become more attractive. What would you recommend for an investor to do?
Since I founded Tsai Capital over 20 years ago, I can tell you, Tim, there has not been really one year in which the news was good. Every single year, there seems to be something going on that worries investors. So what we do is we really take a long-term approach when we look at companies. We think long-term, and we look at the underlying fundamentals of those individual businesses. We're really not focused on the broader macro environment, at least to the extent that it would affect the companies that we're investing in. Our goal is really to find the best businesses on a global basis, high quality businesses that can withstand different environments, because the news will always be bad from time to time. So to answer your question more simply, we really don't focus on the macro. We're focused on individual businesses, and I would tell investors the same thing. Don't invest for the short term, think long term, think about buying quality companies that you can own for many years. And if the market is weak, if those stocks are weak and you happen to have more capital, that's the time to buy when prices are down, not when prices are necessarily up.
Yeah, but you see the opposite when you look at the mainstream. People shop around now for interest rate. They do like monthly savings or day-to-day savings, and they look like, oh, here I get 2.5%, here I get 2.7%. And they're so obsessed about it, they have waited for it. And I think they are too worried with the stock market. They are like happy to get 2.5%.
It's a great point you make, and it's something that might feel comforting in the short term, but actually keeping your money in cash, even at 2.5% or 5%, is not a good long-term strategy. I figure that, and you mentioned inflation earlier, I figure that the value of currencies, particularly the dollar, depreciates by about half every 17 years or so. There's inflation. Purchasing power is diminished over time. So how can we offset the effects of inflation? How can we offset the effects of a weakening currency? And the way to do that is to buy quality companies that are themselves growing and ideally can raise prices for their own products and services, which helps then to offset inflation. Mm-hmm. Owning equities, owning high quality growth companies, the kinds of businesses that Tsai Capital focuses on, is a better strategy than having cash in the bank, earning 2.5% or even 5%. And don't forget, that's taxable.
Yeah. So your long-term return is not taxable?
Our long-term return is taxable for most client accounts, unless they're foundations, nonprofit accounts, or retirement accounts. They are taxable. However, there is a tremendous difference when you're getting taxed every single year versus being able to hold a company and let it compound for you over many years in a tax-deferred manner. If there is any gift that our government, and I say our being the United States government, has given investors, it's the benefit of not having to pay tax on unrealized gains. There's just a compounding effect that you get from allowing your capital to grow in an exponential manner and without tax along the way.
That's hard to understand, the effect of it, right? It's compounding is difficult to... Yeah.
Absolutely, and it's difficult because the human mind thinks in linear terms. Our genetic programming, our history of living millions of years on the savannah has not taught us to think in exponential terms simply because that kind of thinking was not useful to us. We never developed that kind of thinking. Linear thinking was much more valuable, but today we live in a modern society where math, money, these things are very important to us. And so we need to think about that. We need to take a step back, think about, is it better that I get 2.5% or 5% in a bank, pay taxes every year on that interest? Or am I better off buying a company that is growing faster, not paying tax for the next 10 years, and then paying tax at the end?
Yeah.
Mathematically, it's a no-brainer.
Yeah. And what's your average holding period for stocks, roughly, like?
So when we invest in companies, we invest with the idea that we're going to invest for a very long time. Obviously, we have that permanent mindset. But things do change. Fundamentals change. The world is dynamic. So we will sell businesses from time to time for various reasons. And typically our average holding period is around 5 years.
Okay. And who is your idol, or what kind of strategy do you use, and where have you learned the most from?
I would say that I have a few. My earliest idol was my late father, Gerald Tsai, simply because I grew up with him. He taught me so much from a very early age. And I had the ability to see how he worked, how he invested. And I was very fortunate to be able to be surrounded by CEOs of major corporations from a very early age. And I got to see how they thought and what they were doing. My late father had a remarkable ability of being open-minded. He was a very curious person. I think that's an incredible trait as an investor, as a value investor, scouring the world for wonderful opportunities, potential opportunities that have been mispriced and misunderstood by others. Having a sense of curiosity is, to me, it's a must. And my father instilled that sense of curiosity in me at a very early age. He taught me never to dismiss a company just because on the surface it might appear expensive. I think that's a trap that many value investors fall into. They look at a stock and it has a seemingly high PE ratio, and they dismiss it. They say, oh, too expensive. They don't bother doing the work. But sometimes great investment opportunities, they don't screen well. You have to do a deep dive. You have to do deep work to try to understand what's really going on with a business. Mm-hmm. So my late father was certainly one of my big influences. I was also fortunate to meet Charlie Munger a number of years ago. Of course, I knew about him for many years. I studied him for many, many years. He's been an inspiration of mine, a silent mentor for many, many years. But having had the ability to meet him in person was so amazing and reinforced for me a lot of what I already learned. And the third person I'd say that was super influential to me, who I never did get to meet, was the late Philip Fisher, who said that once the work has been done properly up front, the time to sell a company is almost never.
Yeah. Mm-hmm.
And that brings us full circle to what I was speaking about earlier, and your question, Tim, about talking about how we think about holding a company. The time to sell is almost never. So that is the right mentality, at least for us, to initiate any position with.
Yeah.
We go in with that permanent mindset, and we then stay in tune with what's going on, of course, with the underlying business and the competitors, the customers, suppliers.
Mm-hmm.
If things change, as Keen said, you have to change with the facts.
Mm-hmm.
But otherwise, the time to sell is almost ever. The first rule of compounding, to create this exponential growth that we spoke about, is not to interrupt the compounding.
And how do you deal with a bad quarter? Quarterly results are really bad and the stock goes down. You're pretty fresh in the stock.
So that's a great question. How do I deal with it? I don't deal with it. Other than perhaps using that sell-off as an opportunity to initiate a position in a company that's been on my wish list. But if it's a company that we already own, if they have one bad quarter, it's very unlikely we're going to do something. We might add more, but sometimes the stock price decline is justified, and sometimes it's not. But we typically don't think in quarters.
Yeah.
I mentioned my father as an influence. I remember very clearly working in his office as a teenager. I grew up in Greenwich, Connecticut, and over the summers I often would work with him. So I would take the train in the Metro North from Greenwich and do this commute to his office, which was the Pan Am building at the time. It's now the MetLife building. And on my first day of this internship that my father gave me, he sat me down and he had me write down all of these P ratios and dividend yields, very basic stuff, but to try to get me to think about companies like this. And at the end of the day, we were talking specifically about companies and quarters and this idea of estimates, which I had not really heard too much about. Wall Street estimates, buy-side estimates, whisper estimates. So I was thinking, what is this all about estimates? And it was very much based on the quarter. My father was running a Dow Jones 30 company at the time, or roughly around that time. He was the CEO of Primerica, which was a Dow Jones 30 company. So it's one of the largest companies in America at the time. And he said to me, Christopher, you don't know how many ways companies can make their quarterly estimates. There's the ability to take latitude with respect to depreciation, for example, inventories. So companies move things around, not necessarily because they want to deceive investors. It's just part of how they're moving their internal books. A lot of their profits are also based, the management is often thinking about compensation in the shorter term. And so internally, and it's not just the CEO, but internally within many, many departments, companies are moving around depreciation and inventories and so forth in order to make their internal estimates. So I pay less attention to quarter-to-quarter results and more attention to the long term, particularly because we are investing in companies for the long term.
how was it growing up with him? Was he strict? Did he? How was he with organizing your life growing up as a teenager? Did you do a lot of schooling and classes, or he left you a lot of freedom to do?
Interestingly, my father never said you should go into finance.
Why?
I don't know why. Maybe it was he was too busy running his own businesses. Maybe because he wanted to give me freedom. Maybe because he didn't think about, guiding me in this way. All I know is he never said, take a look at investing as a career option. I came across Value Line very early in my life, and I was so excited about Value Line.
That's those charts, long-term charts?
Long-term charts with roughly 12 or so year snapshot of the company's fundamental history, as well as Value Line's predictions about the next 3 to 5 years. I still read Value Line religiously every week today. That's what got me exciting about investing, as well as a few other things. But my father never pushed in that direction. What he did say to me, to answer your question, is that whatever you do in life, make sure you do it well. It's almost this, and he was Chinese, but to me, it just, as I'm thinking about this and speaking with you, Tim, it reminds me of this Japanese concept of Kaizen, which I'm paraphrasing, but it refers to the idea that continuous improvement over time leads to tremendous change, tremendous benefit, and it's like this idea of compounding as well. So he said to me, I don't care what you do, just make sure you're great at it. Give it your all.
Did he teach you how to deal with money? I mean, you grew up very rich. How was that? Was there a lot of money for you too as a teenager growing up, or was he kind of limiting it and teaching you to be careful too? Or
I was not given a lot of money to spend as a teenager. I had an allowance. I had gardening jobs. I had to work for things. I had to write a proposal if I needed a new computer, for example. So it wasn't just given to me. What was given to me was a certain lifestyle, and I can't deny that. I mean, we had, and I never really, I never took it for granted. It was just there. It was part of my life. So I guess it was just part of my life. I mean, we had private planes, we had yachts, we had helicopters. There was all of this stuff, but it wasn't something that I said, "Oh wow, this is really cool. Like I have this, other people don't have it." It wasn't like that. What was important to me was getting the things that I wanted, because that was already there. That was already part of my life. So I wasn't trying to get more of it. It was just there. What I wanted was more books to read, fishing gear, things like that, and computers. In order to get that, I had to write a proposal. It wasn't given to me.
And your friends and the other kids, they also kind of were wealthy, right, back then? You went probably to a private school and...
Yeah, I mean, like with any, I did go to a private school called Brunswick, which is an amazing school in Greenwich, Connecticut. And yes, most of the kids were pretty well off, but there are kids that are on scholarship as well, or financial aid. But like with any school, what's nice about Brunswick is that everybody was very well integrated. So I had friends of various socioeconomic backgrounds.
Another topic, when I look in your portfolio, I think you have to file it. And I think you like tech stocks from California a lot, right? You have like, I don't know exactly about Apple and other stocks in your portfolio. Like, what else? Alphabet and
We own Alphabet. We
We own Apple, as you mentioned. We own Google.
Cool, yeah. How is that like? One thing you mentioned, the PE ratio is not everything.
Right.
But some people say like, oh, it's a difficult time because advertising shrinks now because the economy is not doing so well, and those companies get hurt. There were some layoffs, and the earnings were not, the last couple of quarters were not amazing, but it doesn't matter to you.
It doesn't matter to me on a short-term basis. Another lesson I learned from my father was one derived from a little fishing trip. I mentioned that I liked fishing gear. I had a small little boat, a 16-foot Boston whaler. And one day, on one of the weekends, I went out with my dad and we went fishing. And I cast the rod into the wind. And he said, Christopher, you can't do that. It's just like in investing. You have to position yourself with the wind at your back. That was a very interesting statement, which I didn't quite understand until I was older. But it's a lesson that he learned from my grandmother, who had an incredible career trading stocks on the Shanghai Stock Exchange around World War II. So he learned that lesson from her and he passed it on to me. And coming back to your point about tech companies, to me, many of these tech companies, not all, but a select group of tech companies are the infrastructure of the economy, just like railroads were the infrastructure of the economy during the time of Cornelius Vanderbilt and Jay Gould. This is infrastructure. And not to participate in that infrastructure is arguably irresponsible. Tech companies are also asset light. They have a lot of pricing power in general. You spoke about inflation earlier. What better way to overcome the effects of inflation than to be invested in high quality growth companies that they themselves have high pricing power? So I like a number of tech companies that are sticky, have pricing power, that are dominant in our lives, that are like the infrastructure that existed when the railroads were being built.
And you have mostly US companies, I think, right? You don't have that many international corporations.
We have primarily US domiciled companies because I do prefer the transparency of GAAP accounting, my understanding of GAAP accounting, and the rule of law and stability that exists in this country that I'm familiar with. I'm not saying it doesn't exist in other places, it certainly does, but I'm familiar with this country. But the companies, while they're domiciled here, they're typically very much global companies. Tsai Capital investments are global. And if I were to do a look-through analysis of where the revenue and earnings are coming from, around 2/3 of the profits of the companies that we own on a weighted average basis are coming from outside the United States. So we own a truly globally oriented portfolio that happens to be primarily headquartered in the States.
Yeah.
And some of these businesses are tech companies in disguise. You mentioned that we own tech companies, and the obvious names are the Alphabets, the Amazons, the Apples of the world. But what about Nike?
You have them too.
We own Nike, and almost 40% or so of their business is direct to consumer.
Yeah.
That piece of the business is a more asset-light piece. It's a more scalable piece. It's a higher margin piece. So we own tech companies that are not necessarily apparently tech.
And did you take a look at these Chinese tech companies, Alibaba and Baidu? Charlie Munger was even a fan of Alibaba, and I think he changed now his mind a little bit. Did you take a look at those, or you don't invest? You wouldn't invest there because of some regulations and problems, maybe?
We took a look at a Chinese company that is a well-known tech company, but we didn't make any move on it.
Why was that?
It's primarily because I just feel more comfortable with the knowledge and understanding that I have of US-based companies. And I think it was Buffett who said that in investing, you don't get paid extra to jump over higher hurdles. We want to eliminate blind spots as much as possible, make the hurdles as low as possible, and when the situation is too challenging, when the wall is too high to climb, we just don't do anything.
So safety first, don't burn money is your number one goal?
Well, that has to be, because in order for compounding to work, you have to preserve your capital. And I'm not talking about on a quarter-to-quarter basis. I think in order to be a successful investor over the long term, you have to deal with equanimity with market price declines of 50% or more. You just have to get used to it. What you have to avoid, though, is the permanent impairment of capital. And how do you avoid the permanent impairment of capital? One of the best ways, I think, is to avoid blind spots. China has too many blind spots for me, at least for now.
And the turnaround, like company, wouldn't be so much on your screen, like, because it's too risky, right? If you say this company is struggling for some reason, we don't know 100% if they make it or not, it wouldn't be probably an investment for you.
It would likely not be an investment for me unless for some reason there was something that I really liked about the business, something that I understood about the management team, where it made more sense than buying more of a company that we already own. If we could eliminate the blind spots on that kind of turnaround situation, and in addition to that, that potential investment made more sense than buying more of what we already own or something on our wish list, then we might do that. But again, why raise the hurdle?
And how about Europe or Japan? Warren Buffett is now in Japan invested, and he has a few companies, family companies in Europe.
I love European businesses, particularly companies in Germany. I've had my eyes on certain German-based companies. I have not spent a lot of time on Japan.
Good.
And by the way, those German companies have a lot of business in the States. They do a lot of business in the States. So they themselves are very multinational, at least the ones that's been on my list.
But you haven't done an investment in Germany yet, or?
We have not made an investment in a German company yet. We did make an investment many years ago in a Hong Kong headquartered company. But this company had a very long history. It was a company called Jardine Matheson, and this particular company was founded, I believe, in 1832, and derived most of its profits from Asia, over 90% of its profits from Asia. And it was in businesses that I could relate to. So, for example, supermarkets, hypermarkets. They had a stake in They have a stake in Mandarin Oriental hotels. But we don't own it anymore.
Okay. Costco you own too, right?
Costco we own, which is in many ways a tech company.
It's kind of also like this German Aldi concept, really deep discounts for the consumer. good deals and fair deals, right, with good quality.
Costco has all of that, and has an amazing business model that not only brings delight to the consumer and the best value to the consumer, but it brings the best value because it operates under what Nick Sleep would call shared economy scaled.
Yeah.
This idea that as you grow and you scale, you don't pocket all of the extra margin that could be had. No, you give some of that or all of it back to the consumer, which then drives more volume. It creates a flywheel. Costco operates with this business model, and as it scales, it gives back to the consumer, and its moat actually gets wider.
Yeah.
So I'm a big fan of companies that operate with a scale economy shared business model.
Yeah.
And I'm constantly on the lookout for those types of businesses because they often don't screen well.
Yeah.
They look expensive,
yeah.
but the earnings are often these companies are under earning what they could earn.
Yeah.
So you have to be careful comparing this kind of business, comparing a business that is run by a management team that is looking at the next 20 years and not the next 5 years, that is maximizing earning power for the next 20 years and not immediately,
yeah.
and thereby compressing short-term earnings, making the PE look higher than it might actually be if they ran the business another way.
Yeah.
These companies might not screen well. Amazon, exactly, Tim.
Amazon Prime is an add-on for free.
Absolutely.
Yeah.
Amazon and Costco. In my opinion, Tesla is another business that operates with a scale economy shared business model. Geico, Progressive. There are not a lot of them.
Yeah.
Many of them happen to be private.
Yeah.
I wish they were public.
But Tesla makes billions of earnings now, right? The earnings are amazing, right?
They have fantastic earnings. They have fantastic free cash flow. And they have what's misunderstood is a very high reinvestment rate on incremental capital. We figure over 80%. So the incremental capital, the new capital that they're investing in their business is earning 80% plus. But Elon is operating with that same kind of long-term philosophy. And so, to your point, they are making a lot of money now. However, they are, in my opinion, massively under-earning on the business today. And so their profits are purposely compressed because their market, their TAM, their total addressable market is so large. And I'm not talking just about auto. I'm talking about other areas like energy, which is in the trillions of TAM. They are at the very early stages of entering these markets that are massive. Yeah. And they're positioning the company for competitive advantages, so they have this moat. And that often means, the consequence of that is often to under-earn on your business today, making the valuation seem actually higher than it is.
Yeah, Tesla gets criticized a lot for the management style. They say Elon Musk is kind of lost. He's like on Twitter, he posts every day, and people say, why does he do this political stuff? This provocation.
But to these people, I would simply say, wouldn't you want every single company that you own to be managed with in such a way? I mean, why would you not? Look at the returns that have been generated under his stewardship.
Yeah.
So if that kind of noise, and that's, to me, a lot of it is noise, if that kind of noise is too distracting, then maybe you're not focused on the fundamentals of what actually drives the intrinsic value. I'm not sure that his tweets actually drive the intrinsic value one way or another.
What's your take on Spotify? You have them too. in your portfolio?
So we don't own Spotify. It's a business that is run by also a very long-term thinker in Daniel Ek. And Daniel has publicly said that he has a tremendous amount of patience. It's a business that is growing very quickly, 20% plus. They're scaling, but they have difficulty in the sense that a lot of their scale does not accrue to them fully. It accrues to the labels.
Yeah.
And so it's a different business model than, for example, Netflix, where Netflix would spend a certain amount on content, and that content then can be leveraged over a growing subscriber base. In the case of Spotify, as the subscriber base grows, the revenue that they have to share with the labels also grows. So there's less leverage in the business model than there is in a company like Netflix. On the other hand, Spotify has a number of very unique attributes that to me are positive that Netflix does not have.
Yeah.
But we don't own Spotify today.
Oh, not today?
We
but
don't
in
know.
The past?
We have owned it, yes.
Oh, okay. And what's your take about Netflix then?
Netflix is also a business that we used to own. We don't own it today.
Okay. And why did you say goodbye?
I typically don't comment on why we...
Okay.
Typically, I try to avoid commenting on why we buy something and why we sell something.
Okay.
Once in a while, I make an exception, but it's very hard, like when you put yourself out publicly because of this. We were talking about ancestral history and thinking linearly and not exponentially. Yeah. We have other biases that stem from our evolutionary history, and that's this idea of commitment and consistency. Yeah. That Robert Cialdini so eloquently talks about. It's just easier to change your mind when you don't talk publicly about why you bought something or why you sell something, because something might happen with Netflix where maybe we want to own it again.
How do you get your information? What is a typical way for you? Do you go to conferences? Do you talk sometimes to managers? Do you listen to their calls? Or do you read research reports? How is your typical way, like you get in touch with the numbers and story? And
well, I love to read, and I love to read nonfiction, and I typically don't read newspapers because I'm trying to get information that is not that everybody else is not getting, every single day in the format of a newspaper. Yeah. So I spend a lot of time reading nonfiction. I spend a lot of time reading annuals and 10Ks, but I think that one of our biggest advantages at Tsai Capital is the network that I've developed. So I have a very strong network of fellow investors who I'm able to hear what they're thinking. I'm able to bounce thoughts off of them, get ideas from them, and we share ideas openly amongst more than a dozen very close investor friends of mine. I also created an advisory committee. We have an amazing short seller on the advisory committee who used to work for George Soros for 10 or so years. So when there is an idea that I have, it's helpful for me to bounce it off of him, understand what he's thinking, because he's looking at things and has the ability to look at things from the other side so well. Yeah. So it's the network of investors that really, to me, is one of our deep competitive advantages, and it's something that is not necessarily easily replicatable.
These investor conferences and talking with all these presentations, is that something you would go, or is that not so much?
I love going to investor conferences, particularly when so many of my friends are speaking at them. Tom Rousseau just spoke in Omaha. He gave a fantastic presentation. My former boss, Mario Gabelli, spoke also in Omaha. I got to spend some time with him during one of the days. I learned so much from him during the presentation that he gave.
Yeah.
I learned so much from him every time I hear what he has to say.
Yeah.
That happened at the conference. So I highly recommend to investors that they go to the correct conferences that do add value. My friend John Mihalovic runs MOI Global. He puts on the Zurich conference, he puts on Lattice Work in New York. These are great conferences.
How is about CNBC and all these daily media shows? And
there are a few CNBC segments that are amazing. Speaking of friends and mentors, Ron Barron has been a mentor of mine. Ron Barron often appears on CNBC.
Yeah.
I stop everything when Ron Barron speaks because Ron has an ability to look at the world in a very rational way.
Yeah.
And he often will speak for an extended period of time on CNBC.
Yeah.
But most of the presenters are talking about what's happening in the market on a day-to-day basis.
Yeah.
And so to your question earlier about how I think about these things and the noise and the concerns that are happening today, like inflation you mentioned and interest rates and potential recession, right?
Yeah.
I don't get so involved in that thought process.
Okay. What was your best investment if you look back?
It's easier to think about the worst investment because I can tell you we did very well in certain companies that were asset light. Asset light business models have this ability to compound.
Yeah.
And I'm very positive about the companies we own today. So I don't want to run any victory laps yet. And I'm hopeful that some of the companies that we own today will wind up being the best investments.
Yeah.
So let's leave that part aside and let's focus on my mistakes. One of my biggest mistakes was investing in a company that wound up with fraudulent accounting issues. It taught me that even if you do all of the work and you believe you understand the numbers, you do have to leave some latitude for the fact that maybe the numbers are not accurate.
Yeah.
And how do you then differentiate an accurate financial statement from an inaccurate one? I think that investing in people is the key. Understanding the people behind the business, understanding their integrity. Let me give you an example. There's a company that we own called CoStar Group. CoStar Group is it's a data analytics company, but consider it the Bloomberg for commercial real estate. Andrew Florence is the CEO. Andrew Florence gave one of the best commencement speeches that I've seen. And for your viewers, I highly recommend watching it. You can just go to YouTube and Google Andrew Florence CoStar commencement speech. Yeah. And if you listen to this commencement speech, you'll learn a lot about all the struggles that he had to go through in order to build this company. Yeah. Is that somebody who's going to create fraudulent accounting? I don't think so. So I'm looking for other evidence in our research process, the intangibles, insights into how management thinks, insights into the culture of the business, in order to help avoid situations that I wound up in the past, where the accounting is actually not as it appears to be.
Which company did this fake or scammy things?
I'd rather not say.
Okay, and you started around the dot-com bubble?
Yes.
Around how was that? Like, did you make mistakes back then? Everyone made mistakes.
It was not fun for a little bit.
Yeah.
Because think about it this way. I started managing money as a teenager. Before I formed the current Tsai Capital business, I was managing money just for a few local business people in Greenwich, Connecticut. One of the guys was a gentleman by the name of Johnny Chang, who was the proprietor of my favorite Chinese restaurant on Greenwich Avenue. And we started talking a lot about companies, and eventually, by the time I was 15 or 16, I think it was 16, I convinced him to give me all of his life savings, which was about $400,000 at the time. And so I started to invest money for him, and then other local business people in town. That was an amazing experience. But fast forward to today, like, and a lot of these clients were with me from the early age. But I started off with understanding or thinking I've understood everything my father taught me and everything I learned from Charlie Munger and Buffett and Phil Fisher. And I did that for Johnny Chang in my teens. And I did the same when I launched Tsai Capital. But it just so happened when I launched Tsai Capital was during the internet bubble, around that time, when a lot of what I learned was actually being thrown out the door. At least it was not being appreciated by the market. So it was a very difficult period, but we came out fine. It was a difficult period because I was onboarding clients and losing money for them almost on a daily basis. But it was on March 10 of 2000 that the market peaked. How do I know it was March 10? It's my late father's birthday. On March 10, the market peaked, and the so-called value stocks or old economy stocks started to come back, and we kept buying. We were buying Progressive Corporation. We were buying Genuine Parts at 6 times earnings with a 5 or 6% dividend yield. We were buying Berkshire Hathaway. We were buying wonderful, steady compounders at huge discounts. And we came out of the bubble looking very strong.
Yeah, nobody cared about those stocks back then. Nobody bought them, right? I thought.
Nobody cared. Buffett had lost his way, right?
Yeah.
In fact, how many times has Buffett presumably lost his way?
Yeah, he was on the cover of Barron's, right?
Right.
He lost it. Or maybe not, yeah.
He's presumably lost his way many, many times.
Yeah.
Just like Manhattan real estate has presumably been dead, right? How many times has the obituary been written on Manhattan real estate? We're filming here today in Manhattan. And Manhattan, I don't know how you feel, Tim, but it feels to me like it's more vibrant than ever.
Yeah. But some companies moved to Florida, to Texas,
and Google opens a headquarters in Manhattan.
Yeah.
So it's dynamic.
Yeah. Okay, great. I think, is there something else you want to add?
What would be helpful to your audience?
What would be a good advice for somebody who wants to save and invest and to avoid a lot of mistakes and people get lost, I think, with the noise that people watch the daily noise and they get sidetracked and nervous and anxious.
There are companies today, trading houses, hedge funds, that are trying to capture price discrepancies over milliseconds. Think about the players that you're competing against. Firms that have substantial resources, research teams, and technology that allow them to capture price inefficiencies or discrepancies over milliseconds. How can you possibly compete as an individual investor against that? And I feel that as I've gotten older, the world has become even more short-term minded. So to answer your question directly, one of the best ways to get an edge, one of the best ways for an investor to build savings is to think long-term. And that's easier said than done. Yeah. It's like telling the guy or the woman that he or she has to go to the gym every day and do this kind of exercise because in 2 years you're going to look great. People don't like delayed gratification, but the mathematics don't lie. The real value accrues to long-term shareholders in companies like we invest in, high-quality growth companies that are compounding. So I would suggest focus on the long term, focus on areas where you believe you have less of a hurdle to jump over, avoid the speculative. One person's speculative, by the way, might not be another person's speculative. Focus on what you believe is your circle of competence. And don't stay always in that center of the circle. You have to continuously push against the edges of the circle, which means you have to continuously try to understand what's happening in the world, new technologies, new developments, because the circle is changing. The world is changing.
Yeah. And what's your take? People say, oh, why don't I can just buy an ETF? And they say, yeah, I don't need an own strategy and stuff. There are many people that do that pretty successfully.
I think it's a great strategy.
Yeah, okay.
I think just buying an index fund, a low-cost index fund, and continuously adding to it, particularly when the markets are down and there is extra noise, extra concern, that is a great long-term strategy, and I think you'll come out well ahead.
Mm-hmm. And your goal is to outperform the ETF, right? The index.
Our goal is to add value to our clients above and beyond what they could get in an index fund.
Okay. Mm-hmm. Good. And the last question about your art. You're a huge fan of Ai Weiwei. How did that happen? What happened? Did you meet him or?
I met Ai Weiwei many years ago, and I wasn't familiar with his art at that time. I mean, he's been well known for decades now, but I didn't do a lot of in-depth research on his work. At the same time I met him, I had just bought some land in upstate New York. And we had not yet found an architect. So I had this crazy idea, well, why don't I just ask Ai Weiwei to design the home for me?
He's not an architect or artist.
He's not a trained architect, but he's an artist.
Yeah.
And many artists can create the idea of a wonderful home. Yeah. And so surprisingly, Weiwei said yes. So Weiwei did the design for the upstate home, and we hired a local engineer and a trained architect to take Weiwei's design and translate it into a buildable form.
Yeah.
The house turned out to be really wonderful, and then we hired him to build a guest house in addition.
Next to it.
Next to it. Yeah. But when the main house was done, we realized, we have this fabulous house, but we don't really have much work by Ai Weiwei, the artist. So I decided to spend some time understanding Ai Weiwei. And my husband and I made it our goal eventually to go in depth and to collect him in depth. And from that moment, we became very close to Weiwei. I mean, Weiwei is one of our close friends today, and it's an amazing thing to be able to collect an artist that is still alive.
Yeah. And is it an investment or a hobby, his art?
I don't like to lose money. So I'm not going to buy anything that I think is going to decrease in value. I'm a huge fan of Ai Weiwei's work. I think he's an amazing artist. And I also think that he is one of those few artists that really represent our times. And he is also an artist that is still undervalued today. That's my long-term thinking. But we don't buy any art. We're in a room full of art now. Behind me is a painting by Shainan Xing, who, from what I understand, is actually one of Ai Weiwei's favorite artists.
Yeah.
We did not buy Shainan Xing or all of the other works as an investment. First and foremost, as an investment, we bought these works because we love them. But we also didn't buy them because we think they're going down.
Yeah. Okay.
We believe in the careers of the artists that we collect.
Yeah.
In addition to, obviously, the substance of what they're creating.
Yeah. Do you buy directly from the artist then?
We buy all over. We buy directly from artists. We buy from galleries. We buy from other collectors.
Yeah.
It depends what situation happens to pop up at the time. Ai Weiwei is very unique in the sense that we've worked with Weiwei to help, build this collection. He has really, in my opinion, been instrumental in helping to shape the collection. He's curated it in many ways. We have work from the 1970s, 80s, 90s, 2000s, every decade. And some of these earlier works, they just don't pop up in auction. They're in the hands of private collectors, so often we have to go to private collectors to acquire the earlier works.
And you are one of the largest in the world collector of his art, or?
I think so. I mean, the world is dynamic, as we spoke about. We have around 50 or so works by Ai Weiwei, which I believe makes us one of the largest collectors.
How much does he create?
Weiwei is quite prolific, as was Andy Warhol.
Yeah.
Some works are harder to create than others. There's a work called The Map of China, and there are not a lot of Map of Chinas by Ai Weiwei, just because the work that goes into it is so substantial.
Yeah. Yeah. And he has also then a factory and a lot of employees, or how is his creation of art?
Everybody's definition of a lot is different. He has a number of people that work with him on different projects, not only from creating art, but also on film.
Yeah. Okay. He lives in London, or?
He lives in multiple places. Primarily, I believe he's spending a lot of time right now in Portugal, just outside of Lisbon, because he's building a new studio just outside of Lisbon.
Yeah. How is his relationship with China? Has it changed, or is there some progress, a positive one, or what is?
I don't know specifically what his relationship with China is right now.
Yeah. So he doesn't talk about it also probably a lot, or?
He may. I'm not up to date.
Okay. Great. Yeah, that's amazing. So of your art is probably 80% his work then, or?
It might be more than 80%.
Okay.
But we are expanding into other artists as well. We have our eye on one particular artist who we absolutely love, who we started looking at around 5 years ago, and who we thought his market prices were more than double what they should be.
Yeah.
And finally, the prices are coming down. As I said, I don't like to lose money. He's one of my favorite artists. He's one of my husband's favorite artists. So maybe one day we'll wind up with something of his, or maybe we'll wind up with a dozen of his pieces. We'll see.
The name is secret.
Name is secret for now.
The secret.